Are you a high-income earner looking for smarter ways to keep more of your hard-earned income instead of handing it over to the IRS? What if you could own that dream vacation home and use it legally to shelter your income? It's a little-known loophole in the tax code, and in this video, I'll show you exactly how short-term rentals can help you do just that, become a powerful tool for building wealth and saving hundreds of thousands on taxes. This isn't just theory. I'll walk you through how a couple was able to shelter multiple six figures of income just by making one smart move. Most people completely miss this opportunity, usually because their CPAs don't know about it. But after this video, you will. A few years ago, I met a couple making multiple six figures a year, but they also had a huge tax bill. The husband ran a successful pool supply business, and his wife, she owned and managed several vacation properties that she listed on Airbnb. She was doing all the guest communication, doing all the logistics for the cleanings and repairs, but here's the thing. She had no idea that those rentals could actually help them shelter their income. This was just weeks before the tax deadline. Once I walked her through the short-term rental tax strategy, I referred her to a real estate CPA who understood the rules. And with just a few adjustments to her filing, they were able to shelter hundreds of thousands of dollars of income legally. Now what changed? The only thing she was missing was the knowledge. After talking to me, she quickly realized she already met the criteria to be able to claim the tax benefit. The problem? Her CPA just never brought it up. And sadly, this isn't rare. Most CPAs just aren't trained in real estate tax strategies. They don't bring it up because they don't know how it works. That's why I'm making this video. Because once you understand how short-term rentals work and how to meet the criteria for this tax benefit, this can become a powerful way for you to reduce your taxes and build real wealth. So here are the 4 steps you can follow to turn your vacation home into a tax shelter. Step 1. Buy a cash flowing short-term rental. This first step is simple, but it's critical. Buy a short-term rental that actually cash flows. That means it puts money in your pocket every month, not the other way around. Sounds obvious, right? Actually, this is where a lot of people go wrong. They fall in love with a property and skip the part where they actually run the numbers. So they end up overpaying or buying properties that don't cash flow, which turn into liabilities instead of assets. In our short-term rental course called Accelerating Wealth, we focus heavily on deal analysis. We teach our students how to analyze the deals the right way using a short-term rental cash-on-cash calculator, and how to consistently acquire assets, not liabilities. This means thinking through every decision carefully, especially with short-term rentals where there can be unexpected regulatory risks like cities implementing short-term rental bans or HOA restrictions that can quickly shut down your Airbnb business. Because here's the truth that nobody tells you. The tax benefits are compelling, but they only matter if the property itself makes sense. You should not be losing money on the deal. Start with a great investment, and the tax savings should be the bonus, not the reason to buy. Once you've bought a solid property, the next step is materially participating in your short-term rental. If you skip this one, you're not going to qualify for the tax benefits. Here's what this means in plain English. To use your short-term rentals to shelter your income, you need to meet one of the IRS's material participation tests. The most common one is this: work at least 100 hours on the property and more than anyone else, including cleaners, contractors, or property managers. So common question we get now is, how do you hit those hours, especially if you don't live near the property? It's actually more doable than you think. With tools like Airbnb, VRBO, and property management software like OwnerRez, you can manage guest bookings, communicate with your guests, coordinate cleanings, and monitor your property all from your phone or computer. But even more important is the setup phase. Many of our students fly out to the property in the beginning and put in 70 or 80 hours in just 1 week. They assemble furniture, they meet contractors, they shop for supplies. That setup week adds up fast. Imagine working 12-hour days for 7 days straight, and that's 84 hours right there, just in setup. When you add that to the time spent managing guest stays and handling other tasks throughout the year, hitting those 100 hours becomes much more manageable than most people expect. And if you're married and filing jointly, here's a powerful advantage. You and your spouse can combine your hours to meet the 100-hour requirement. So maybe one of you handles ordering everything online and the other person sets everything up on site. This teamwork not only helps you meet the IRS's material participation requirements, but also makes managing your short-term rental more efficient and enjoyable. So if you're feeling overwhelmed by the idea of hitting over 100 hours alone, remember, you don't have to do it solo. You and your spouse can work together to make it happen. And once you hit that material participation threshold, you've unlocked one of the key requirements for getting the tax benefit. The next step is to create paper losses to offset your income and lower your tax bill significantly. One of the best ways to create these losses is with something called depreciation. You might be wondering, what's depreciation? Depreciation is the decrease in value of your property over time. It's the same thing that happens to the value of your car. In fact, your car depreciates 10 to 20% on the day you drive your new car off the lot. What's unique about real estate is your property is usually gaining in value over time. However, the IRS lets you treat it like it's losing value over time. That loss shows up as a tax deduction without taking any money out of your pocket. This can make those paper losses get really big really fast. For example, on a $1 million property, you might create $250,000 in paper losses in your first year with bonus depreciation. That means you could potentially shelter $250,000 of active income from your job, your business, or other sources. If you want a full breakdown of how that works, I walk through it step by step in this video here. I'll also link it below. But here's what you need to remember. You're not losing real money. You're using the tax code to make it seem like you're losing money. And the result? These losses can help offset your active income and help you keep more of what you earn. All of this hinges on having a real estate savvy CPA in your corner. Someone who understands how short-term rentals are treated and how to implement the tax saving strategy. Remember the couple I mentioned earlier? Their original CPA had never brought up the short-term rental tax strategy at all. That oversight almost cost them hundreds of thousands of dollars. And unfortunately, that's not rare. Most CPAs just aren't trained in real estate specific tax strategies. They don't understand how material participation works, and they don't know how to apply the short-term rental tax rules. And they may be even giving you advice that's just flat out wrong. So here's what I recommend. Don't just rely on whoever did your taxes last year. Do your own research first, and then interview your CPA. Ask them directly if they understand how to implement this tax strategy. Make sure they've worked with other clients who use short-term rentals to shelter income. Because even the best strategy can fail with the wrong tax advisor. And the right CPA, they can help you unlock tax savings most professionals never even hear about. This strategy has the potential to make a big impact. It's going to completely change your tax situation, taking you from paying a lot in taxes to getting a big refund. But here's something I tell all my students. Tax savings can't fix a bad deal. The tax benefits are huge, but they don't make a bad investment great. A lot of people get so focused on the tax strategy and they forget the fundamentals. You still need to buy smart. That means buying properties that make money from both cash flow and appreciation, not just properties that save you on taxes, but lose money overall. If you focus on making money with your properties first, the tax benefits will follow. But a bad investment will cost you more than any tax savings will save you. That's why learning how to buy properties, including short-term rentals, the right way is one of the core focuses of this channel and our courses. So there you have it, the 4 steps for how you too can use a short-term rental tax strategy to shelter your income and reduce your tax bill. Now, if you're a high-income earner who wants to save a ton on taxes and keep more of what you earn, this strategy could be perfect for you. If you want to learn how to buy and manage cash flowing short-term rentals the right way, check out our Accelerating Wealth Short-Term Rental Blueprint course. We'll teach you how to work smarter, not harder, and keep more of your hard-earned money in your pocket. Thanks for watching. See you next time.